What happened last week was extraordinary, and it reignited the excitement over the AI trade, and also that it's broadening. It's not just for the same five constituents.
You see it broadening.
I see it broadening.
You and Jeff, you agree on this?
Yes, I see it broadening, and the market actually is broadening. I mean, it's the talk about small caps, and is definitely indication. The equally weighted S&P is at all-time highs as well.
I did not know that.
Yes.
That's the Alicia Levine magic.
So there is a broadening here. But yes, the move last week was extraordinary. And you have seen a market like this, and it was in the late 90s. And the question is, are we in 95 or are we in 99?
Okay, let's go there. Let's rip it up. We're going to fundamental analysis right now. I'm sorry. It's radically different than the late 90s because of free cash flow generation.
Correct.
They're actually, am I right? There's not going to be 2027. Oh, they actually weren't making profits in 2025.
Okay, so on a relative basis, the tech stocks are cheaper than they were 25 years ago. On a cash flow basis, they are just batting it out of the park on free cash flow margins. And on the operating margins...
You could say like Aaron Judge, you won't insult me.
So, I mean, these are different companies, but, keep the main point, which is that the Fed is cutting into an increased earnings cycle. Okay, S&P earnings estimates are moving higher. The Fed is cutting into it. Banks that are at all-time highs, hence the melt-up.
Isabel Lee with us here this morning.
It's interesting you say that the rally is brought in because we have critics saying and criticizing the fact that the top 5 stocks are driving 12% of the gains this year. But given that, we have Bank of America releasing their fund manager survey. They said that equity allocation is at a 7-month high. There's just a big jump in global growth optimism. But at the same time, there's a record 58% saying that stocks are overvalued. How do you square those two?
Well, because you have to be in the game. I mean, when you manage a live portfolio and you're underallocated and you're waiting for that S&P target of whatever 5,800 and it's not happening, you've got to get invested.
How far behind are active managers right now? To Isabel's great question.
So I think in the U.S. less. I think they're less underallocated, but I think global managers are underallocated because the Flee America conversation was everywhere. I actually wrote a piece about how ridiculous the Flee America trade is because where else are you going for innovation and global and growth and margins and earnings power?
Isabel Lee actually read your piece, just so you know. Isabel Lee with us, folks, in for Paul Sweeney today. I see your nefarious deed here. You are asking questions of the equity giant, Alicia Levine, for your print stories today. I see what you're doing here.
I always watch Alicia. She's such a smart talking head, and she's also a fantastic female. We were just talking about shopping in France, but back to markets.
Oh, please don't continue. Is luxury back? Is the sector back?
Luxury is back.
Right.
Luxury is back. Look what's happened to the household net worth, okay? Household net worth is up about $70 trillion since the beginning of 2020. That means households with financial assets, housing and equities and stocks and bonds and private equity are doing quite well.
Really?
We do have the K-shaped consumer here, but we've had it. This is not new. What's happening is that the top 3 quintiles are seeing their net worth growing, supporting consumption, even in the face of a weaker labor market.
Did you see that stat, Tom? We have the most number of millionaires in New York than ever before, or something like that.
I didn't know
I just know I'm working towards being one of them. But going back to luxury, how do you assess the health of the American consumer? Do you look at luxury or mid-tier or value? What is your favorite tier to look at?
Well, luxury is everybody's favorite tier. Let's just say that. But you really have to look at the mid-range as well. We're going to get retail sales today, so we'll see where it's happening. I imagine there's some slowdown. I think there is some anxiety in the labor market, particularly for the younger cohort, and that's why the Fed is cutting. But I'd say that, for the most part, it's better than feared.
Right.
And the conversations had gotten so negative. I mean, we sat around this table, the apocalypse in April and May, and you just invest right through it.
The number